Kenny, if you were starting buying your first STR with what you know today, what's the first thing you would do?
Oof. Well, the first thing I would do today is
Oof
number
isn't
one.
how you open up a fucking podcast
Yeah,
when I
oof.
fucking
Yeah.
well,
Well,
I
what I
just
know
let in with the
today.
hook. We're
Yeah.
everything we're talking about, you oofed it. What the fuck?
That's funny.
Let's start over. Kenny, if you were buying your first STR with your knowledge today, what's the first thing you would do?
I would go talk to a lender
Why?
because I want to know my options. And I think that so when I first got started, I didn't know what my options were. There were a lot of assumptions, and I think people have a lot of assumptions when it comes to purchasing. And I have a lot of conversations with newbies. Most people assume that it's an investment property, or I have to do at least 20% down, or I don't know what's out there, kind of thing. And I've got my normal lender, and this is what he said. Therefore, this is the only thing. I would start talking to lenders. That's the
Sage
first thing.
advice. Sage advice. Kenny, you're not good at nailing the hook at the very beginning. That's how you keep people to watch
Oh,
longer. But
okay.
sage advice on the lender. I would not have gone down that direction if you would have put me on the spot. And just so you guys that are listening and watching at home, Kenny had no idea that I was going to drop that on him. I put him right on the spot and he came up with a great answer. If this is your first time listening, I'm Bill Faeth. This is Kenny Bedwell. He's the founder of STR Insights. I'm the founder of Build Short Term Rental Wealth, the STR Wealth Conference. And we're excited to have you here because this is something, Kenny, that a lot of people, yourself included, you bought a really shitty piece of land in Arizona. I lost 125 grand on my second, not my first. We've all made these mistakes, right? So interesting that you bring up the lender. I want to unpack that because you help people find properties. I help people find properties. We have whatever involvement in this industry. And I think one of the fundamental mistakes that people do make is their lack of knowledge of lending options. That's why I recommend at least 6 banks. And there's 3 different types, right? There's two, like large mortgage companies, large mortgage brokers like Parker Borofsky at Movement, like Brennan Carls at, the mortgage shop, or a Brian Buckholt at Huntington. They're pretty prevalent in our industry, right? And then I recommend 2 local commercial banks and 2 credit unions, which, oh, well, people think they're the same thing. They're not. They have different programs. They have different underwriting processes, different qualification processes, right? So it's a great piece of advice to really get educated on the lending component. And I think it's not just for first time buyers. I mean, there's a lot of people, that I coach that have no idea of what their options are. They only know about a DSCR product because they hear about it at conferences or podcasts like this or whatever, and they only know about second home loans, right? And they don't know that they can go to the local bank, which I call it the balloon bank. Go to in your local market, not in your home market. If you live in Buffalo and you're investing into Nebraska or vice versa, go to that local market you're investing into, because those are the lenders that are funding the development of those projects. Those are the lenders that know that market. Their appetite to lend there is going to be much more comfortable. And I don't want to say I learned that the hard way, Kenny, but I mean, I went to my bank Pinnacle when I bought my first property, and they're like, we're not loaning down in Gulf Shores, Alabama, and they're the ones that said, go down there and find a bank like us. And they gave me 2 recommendations. And one of them was the guy you met at the very first mastermind meeting, right? Do you remember him?
Alan?
And it's First Cahaba Bank down there. And then, I found Luke at Merchant Marine. And so every single market that I penetrated into, I go through at least that 6. What are what's that next step for you out, like what type of lender are you going to and what are you looking for? What advice are you giving?
Yeah, I mean, I think when you're initially getting started, so personally, I like to go to 2 different lenders. And I mean, even I'm going to purchase a primary residence soon this year, soon ish. And I went and talked to 2 different lenders, and
Did
they
you make
sat
the
me down.
decision where?
North Carolina. So most likely.
Bad
So
decision.
bad decision, or
Yeah.
on the border and potentially in South Carolina. So we
Oh,
shall.
gotcha.
Yeah, yeah.
Should have been
Anyway,
Tennessee, but we'll let it slide.
yeah. The traffic,
More affordable in North Carolina than here.
the traffic is just horrendous in Nashville. So
That's a fact.
yeah. But so anyway, no, I mean, it was the opportunity to sit down with the lender, and then they go, okay, here's your situation. Here's, like I was sat down with Brenna Carls and with the mortgage shop. And not only was she like, hey, this is what you can afford, but then she also outlined, she's like, okay, you're probably going to need to buy, I looked at your tax returns, and you're probably going to need to buy another short term rental this year. And so if you buy a primary at this, then you're going to have to buy a short-term rental, but this is what you're going to be max per. Like she was like outlining the next like 2 or 3 steps for me. And I was like,
Brenna is
Brenna,
fucking amazing.
yeah, I was like, Brenna, like I've never, I wasn't thinking that far. You know what I mean? And I was just thinking like I'm gonna buy a house, like a primary residence this year, and then potentially partner with some people for STRs or do some DSCRs. But apparently, I can do and leverage some debt if I decide to do that, for the second home loan. So anyway, that's really powerful to know all of your different options and avenues. And I think people getting in, they're just like, I got to find the property, but there's all this like pre-work that needs to be done first. And lending is probably one of the first steps in
They
my
gotta have a plan, man. I mean, it's really the first thing for me is you gotta build out your investment plan. I won't even dive into the life plan, that's just as important, but like what Kenny just said is the order in which you purchase and the order and the type of financing that you do is critical. And I see everybody coming in and they're doing second home loans, especially high income earners. And then, oh, I can do 9 for myself and 9 for my spouse, and I can do 18 properties. And you might make half a million a year. You might make a million a year. But then you go in and you buy $5 million of real estate at 7%, and you literally have completely positioned yourself to where now you're boxed into DSCRs only. There's a reason when I started buying, and people think this is backwards. I think it's the exact way that everybody should be investing first is commercial loans at local banks, right? One, because you can get better deals on 20-year, 25-year amortizations versus the 30 years. Two, it's typically easier to underwrite if you know your shit. And that's super important. You have to put a package together for them, which you don't do for Brenna. You don't do for a DSCR. You don't do for a Fannie and Freddie or a second home or a primary residence, right? But you can get better deals. But most importantly, you can buy commercially. You do have to PG it, personally guarantee, but it does not show up on your credit. So, Kenny, I didn't even buy my first property under a second home loan until last year when I bought my first property in Montana. And I've done 3 since then. So my DTI, because that stuff does not show up. And here's a little trick. And I've talked to every banker about this, and I'm upfront with them when I'm filling out their forms and it asks for their mortgages. I don't put that on there ever. And people make a mistake when you have a commercial loan, even though it's a piece of real estate, if it's in an LLC, which they all should be, right? Then why do they give a shit if it could be a coffee shop, it could be a short-term rental, it can be whatever. So because it's a different entity and it's none of the bank's business unless they specifically ask me about the business, they use the word mortgage on their application. So I never put those in there. Now, sure, that business is going to show up on my PFS, my personal financial statement, and then it takes a little bit of an explanation. But by then, they've seen everything. They've seen the cash flow, they've seen the profitability. So it's fine to go in and do that. A lot of them will kick you out immediately because, in most cases, short term rentals are risk for banks. So the bigger that your portfolio gets, if you're not paying down debt quickly, hence why I love 20-year AMs versus 30 or those 40-year interest onlys to pay my debt down, get my principal as low as possible, right? That's going to give me more security when I go in and I try to qualify for a loan of any type, any type. And I think those are things, Kenny, that people don't think about when they're getting in as a newbie. And I'm not just saying property 1 on ground zero. I'm talking property 2, property 3, property 4, right? Because they're not educated on really building out that financial plan and what works and what doesn't work. So I think a lot of people, so what was her advice to you, to do primary first, then investment second, or investment first and then primary second?
I think she was just saying like you already at 2 houses this year. Like this is what you can afford for each one. And then you tap out your DTI if you're doing like just on your primary and secondary homes. And so I mainly just do DSCRs now because I don't really because we know we're planning on moving. Therefore, I know that I'm going to be tapping into my DTI for a primary residence. Therefore, like I keep my DTI very, very low because of that. And I don't want to take on properties. So I like pigeonhole myself into this corner or paint myself in a corner where I can't, move or do whatever I want. And so like I know that. So like I pretty much just do DSCRs or seller financing on properties because like I'm not going to pigeonhole myself. So we had that conversation, but it was interesting to know like what I could afford and what options I did have. So it's not just like, oh, because in my head, and this is the same problem my clients have too, they assume that, for me, I assume that just going to do DSCR and these are the rates and this is what it is. But in reality, if I found something super sweet and I wanted to make it work, I could. And knowing that option's powerful. Now it's not necessarily like the way I would go, but who knows? So it's just kind of like I said, like understanding reality of what the options are out there that you can actually do for financing is a critical piece with getting started before you even look at properties, knowing what you can afford. Can't tell you how many times people came to me and I'm like, what do you think you can get pre-approved for? And they're like, $700,000, 800,000, $1 million. And then they go get a bank approval and it's like 300K.
I will not do any property finding without a pre-approval letter.
Exactly.
So you mentioned owner financing and DSR. How many properties do you own and what products do you have on each property? How many are owner finance versus traditional versus DSCR? And does the DSCR have prepayment penalties?
Okay. Yeah. So I
You own
have
4, right? Is that right? 4
Yes.
properties?
Yes. So I have two are I have investment loans on the other one. The first two I did
Investment
unknowingly.
loan like Fannie and Freddie or like commercial investment, local bank commercial?
No. Fannie and
Okay.
Freddie investment.
So those are personally guaranteed and they show up on your credit report, correct?
Correct. Yep.
Okay.
Yep. But because they've been income producing for so many years, I got them like at the very beginning. So because they were income producing and now it should like so they can use that income. So I have 4 years of tax returns from those properties producing. So it's actually really beneficial. And then I have a decent amount of equity in them and things like that. So it's like it worked out in the end. Like I said, I wish I was a little more. I knew my options. I didn't at the time, and I just assumed, make assumptions and then I have 2 that are DSCR, and then I have 1 that that land I bought out in Arizona is owner finance. So
Nice. Is that reporting onto your credit, the owner finance?
no.
So that's something that I think people need to understand is that you should still try to close an owner finance if possible, you know, and part of your contract should be no credit reporting because an individual can submit that for a credit report when you have an owner finance, right? So that's something a lot of people don't understand. On the DSCR, are you 20% down, 15% down? Do you have a prepayment penalty on that?
So one was 15 and the other one was 20. The DSCR, or sorry, the prepayment penalty I bought down on both of those. I did them. So I bought down from like they were both like 3 years. So
Gotcha.
3 years is over now this year. So
Yep. I mean, I think those are all good options and a good mix. I mean, what scares me is when people go in and they just go DSCR, 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 and they have 5-year prepayment penalties and they get bad deals and they're doing everything. And then they're cost sagging or 1031 and they're just encumbering all of their
So
property.
here's something interesting. And I'm gonna say I know that we're like live on a podcast and everything, but like my some of my DSCR loans have been sold off so many times now. Like one of them's been sold off 3 times. I called the bank because I was like looking through all the documentation to go, okay, like what did I do, a 3 year, 4 year, 5 year? Like what was the prepayment penalty? Because it's been a while. And I called them and they're like, oh, there's no like prepayment penalty for paying off your loan.
Hmm.
And I was like, okay, like that's good to know. So I don't know like what goes on there when they sell off the mortgages and what transfers and things, but and I didn't have any plans to sell it off, but just something to think about, I guess.
It
And
all transfers. It's just they're buying so many, right, that stuff gets, lost. I'll tell you, I've only done 2 DSCR products, and they were my Banner Oak property, my first Banner Oak property, and then my Beach Mountain property. I sold and closed on the Beach Mountain property, and I'm like, "Oh, shit, there's no prepayment penalty on the" because I did do a DSCR on that, and I only owned it for a year, and I had a 3-year prepayment penalty through the lender on it. And they came back, like, 3 weeks later and said, "Hey, we're not able to close your loan. You owe the prepayment penalty on this. You still owe 2 years of the prepayment penalty." And I said, "Can you send me the documentation on that?" And they could never produce the documentation. I ended up negotiating, only paid 1 year of the prepayment penalty with them.
oh, nice.
So I don't know what happens when they move that stuff, but anyways, I think the point is start with your financing. I mean, Brenna Carls does a great job, Kenny, and she's got a brand new podcast, Break the Chains. I would highly recommend listening to it. She does a great job like she did with you, but also explaining to people, we've got a DTI calculator that she put together and her and I did a training on to where you can calculate your DTI. Understanding what you can and cannot do. I just had her speaking to my inner circle last week on one of our meetings, and she really broke down kind of what the qualifications are based on credit score, or really what's eliminated, really what you can't do based on your credit score. And a lot of people think, hey, if I'm under 700, I don't have options. You have options all the way down to 575. You're going to pay a higher interest rate. There's no question. But also, really, 745 now is the new 725. It used to be if you were over 725, you kind of were that gold rated or whatever the hell they call it. Now you got to be over 745. And then the other thing that's really interesting is a lot of people just think like Credit Says Me, Credit Karma is accurate. It's not, just FYI, and understand that those underwriters are taking an average of credit scores. It's not just your existing one at that point. So that history, don't go carry $50,000 in credit card debt and be at 675 and then go and pay it off and then go have them pull your credit 2 weeks later and think you're going to bump up to 725 and be okay. They're looking at that long-term history and that short-term history as well. So we've kind of, I think, beaten the horse on the banking side. What's number two?
I'd go hire Kenny. I mean, that's no, I'm just kidding. So number two. So I'm buying my first short-term rental. I think so. I understand my budget. I think that's so. I guess let's hop on that one for a second. That's big. What does it cost to buy a short-term rental? Okay, so it's not just the down payment and closing costs. Okay, you got to pay for furnishings, amenities, and potentially some sort of updates to the property. So a lot of people and they think they're mainly thinking in terms of down payment. They're not thinking in terms of like, I have, you know, if I just have $100,000, can I really buy a 500K property off that and include my furnishings and amenities and everything? And people, well, I'll buy something that's already furnished. Well, you just limited yourself in terms of what's available and what's for sale. So understanding like what you can actually purchase with your purchasing power with your real dollars is key for, understanding that. I didn't get that at first. It was just go buy a property that I can afford and get pre-approved for, but then oh crap, I'm spending 30, 40, $50,000 in getting the property ready to go, you know?
And
But then
also buying what you should or shouldn't buy.
yeah,
So, I mean, how many properties in the last 24 months? That's 2 years, folks. How many properties have you seen ascend to the 75th percentile, the 90th percentile with no post close renovation or updates?
0.
Exactly. Let that fucking sink in, folks. Zero. So if you have 100K, the other thing too is you really need to understand your financial position.
Yep.
Don't be making $125,000 a year in household income and have taken 10 years to save $100,000 and go buy a $450,000 property. That scares me, right? Go buy a one-bedroom condo someplace or a two-bedroom condo someplace in a market that nobody talks about that has traffic drivers. Find the hole in the market and, then go do
Do a
it better.
burr. Do a
Do
burr.
it better and save some of that cash to renovate. And if you are a high income earner, then you need to be doing research on market appreciation and you need to understand the tax benefits as well. I do not write those into my pro forma, but they are part of my decision making process in the market selection and the individual property selection as well, because I don't want to own any more properties, Kenny. I mean, I'm like over my limit that I wanted to have, but I know I'm going to have to probably buy $3 to $4 million worth of property this year just to offset tax, right? And because I just don't want to write huge checks to the government, but that doesn't mean that I can invest into non-cash flowing properties. I still have to go through the underwriting process. I can't buy for tax first, right? But there are differences. The majority of the people that I speak to, it seems like it might not be fact, but like, oh, I want to have a beach house and I'm ready to buy my lifestyle asset. Okay, but I need the tax benefits. Well, then that's typically not the place that you want to go for tax benefits. Go to northern Wisconsin or Michigan or someplace where land values are way less than going to the OBX or Destin or Malibu or any place in Florida. So I think there's a different strategy based on your financial well-being behind the purchase, right? And also, income and stability and what you really want. So what we talk about the buy box. You need to determine what your buy box is. I think is really number two. Really, that should be number one. What's your buy box? Then go to lender. Then, kind of figure this second part out. And, that's going to be what you're going to qualify for, what you can afford, and understand the risk. Don't rob from your future to make an investment today because you have shiny key syndrome and you see everybody talking about short term rentals and want to jump in, right now. It takes a lot of education, a lot of help today, a lot more, probably like 50 to 100% more today than it did 2 years ago. Right. So I think you got to understand where we're at in today's economic situation personally and in the investment component.
I love it. Yeah. No, I just see too many people going in thinking like, okay, I don't need, like, they're not budgeting. They're not expecting to have to spend money in these properties, and just not the case. The value adds the most common and easiest strategy for people to do to have a successful property. But in order to do that, you have to have some cash, to put into the property. If not, if you're not going to do value add, then you're going to have to do a rehab, an update, and try to get that update financed by a private money lender or the bank, depending on, your experience and things. So,
And then if you are going to get private money or relay, whatever it is, any type of financing for your renovation, you got to factor that into your pro forma. Most people do not, right? Because that's going to be at a higher interest rate. It's typically going to be a shorter term on your payback. It's going to be super expensive and that can just eat all of your margin away. So be careful, understand your finances, look at the banking options, and most importantly, make sure you hit that subscribe button, whether you're on YouTube or Spotify, so you can listen, you can watch. We're on all the channels, Amazon, Apple, YouTube, Spotify, everywhere. So hit the subscribe button, go back and
MTV
check out our past episodes. What's that?
said MTV, right? We're on MTV.
MTV, baby. That's what it's all about. We'll see you guys on the next episode. Happy hosting, everybody.